Hi everyone. So in this video, I want to go over my actual strategy from start to finish, exactly what I do, and I think it'll be really good to kind of to show my workflow and how everything just gonna make sense and fits together. And yeah, my strategy is pretty, I would say pretty good. My overall approach, I guess, to the market. I do have a 92 and 93% win rate as at the time of making of this video. This year I'm so far up about 12.5%, where the S&P is down, I think maybe 10%, 12%, give or take. It's been a pretty good year, no losses so far. So let's get into the strategy. I think it will be really cool to show you exactly what I do, and it's been the same thing for for quite a few years at this point. So we'll go over the boring stuff, the technical stuff, and then we'll go to look at an actual example, to open it up and basically do the exact same things that I would normally do. So basically I mostly sell short strangles, and this is what I will focus on in this video. Of course, I try to stick to 45 days and less. It was a pretty it's a pretty good rule. Theta is pretty big in 45 days, but this entire year I just had trades with over 100 DTE, just because the range that you get to your stop losses is pretty small with 45 days, and I'll show you exactly what I mean by that. So 45 days is ideal, but depending on the market, you gotta use a higher DTE to be able to actually have a pretty good range or a safety range to be able to stay within the position. Now these are the products that I trade. Lately I don't even trade any of the currency futures and the meats, basically from gold and all the way down to soybean oil, but occasionally maybe I'll put some trades on these products, very rarely. So these 10 products from gold to soybean oil, these are the ones that I really look at all the time. My short strikes are always at around delta 20 for the short strangles. And for if I sell a short call or short put, it will be around delta 35. But again, I barely take these trades. I'm mostly, most of my experience is basically with strangles. So I'm gonna stick to what I know best, and for this video, for sure. Now my profit target is always at 50% of credit. My loss target begins at 50% of credit. Sometimes maybe 45, 40, again depending on the range, but. This is a rule of thumb. I never risk more than $1 to make $1. And my stop loss is dynamic, so I'll go over it in just a second. Basically, as the position is getting better and better, I am lowering my stop loss to kind of make sure that I have a good risk management. And again, it's pretty simple. We'll go over it in a second. And I always use CVOL, so the Commodity Volatility Index, for a good entry. Basically, I want to see if the option pricing is relatively overpriced or not, and make my decision based on that. And again, I'll go over it, an exact example in just a second. I can exit the position if my targets are hit, obviously, take profit or stop loss, exit at 21 days to expiration to avoid gamma risk. Usually never, I never get to that point, but sometimes, once in a blue moon, you can definitely get to that point where you have 21 days to expiration left and you kind of need to decide what to do. So I will always exit. I can adjust the position if needed. Basically, never do it. Maybe I've done this maybe one in the past 3 years, and it was a very unique situation. Yeah, so really hard to give an example for that, but this is not something I usually do or ever really. I just take a loss or a profit. That's it. I found it to work really the most efficiently for myself, and I can exit early if something unexpected happens. Let's say I'm in a position on wheat or corn, or I'm in a position on copper, for example, and then we have some news coming out that potentially one of the biggest copper mines in Chile got destroyed or kind of got damaged. Well, at that point I will exit early because I don't want to risk the price going up or down really hard, probably up, and just exit the position early, which lately has been happening quite a lot because many things are happening in the economy. So I definitely have to be really receptive of the news. So the most important thing is I'm just looking for a good opportunity where the risk is worth the reward. Pretty simple, nothing much else to it. And this is the whole point of everything. So I want to make sure that mechanically I have a good position, I have a good range, and I promise you it will all make sense in a second in terms of the good range, what it means, what it looks like. And this is about it for the technical side. Now for the stop loss, for the dynamic stop loss. So again, let's say we are opening the position with a 50% stop loss, which is, again, the max stop loss that I would put on a position. Then at 15% profit, I move the stop loss to minus 35, 20% or 20% profit, I move the stop loss to minus 30, so on and so forth. And at 35% profit, usually I would move the stop loss to 0 or minus 15, depending on the position, depending on what happened. But usually to just break even. And then at 40% profit, I will move my stop loss to plus 10%. So at that point, I either make 50% or I make 10% on the position. And you wouldn't believe, but this will do wonders to your win rate, especially if you follow my exact method, because basically I'm looking to place positions where there's a high uncertainty that there will be no volatility, or the volatility will be coming down, or no price volatility during the trade. This is what I'm trying to aim for. And then obviously to set an estimate stop losses and the ranges, I used the position profile on interactive brokers, which we will go over. But this is the dynamic stop loss. This is what I do. This is a game changer. I mean, I've been doing it for quite a while. It's not something new, but this is amazing because there's nothing more painful than getting to 40% profit and then something happens and the position just goes all the way down to your max, to your stop loss, which is minus 50% if you don't actually move your stop loss. The most terrible thing, and it happens, it happened to me a few times where from 40% it went down to 10%. It hit it, we got out of the position, and then it continued on to the negative territory. It happens, but it is what it is. That's trading. You just gotta make sure that you are limiting your downside as much as you can. And it will just do wonders for your risk reward and for your just for your confidence and sanity as well. So a few more specifics. The risk per trade is up to 4% of the account value. So give or take, I can risk up to 4% of my account value per trade. Sometimes more, sometimes sometimes less. Usually less. I probably never go over 4%. And this just to make sure that we have a pretty small position size and pretty consistent. And I am mostly neutral. I rarely trade directionally, and this is because neutral trading is much more straightforward and it eliminates the need to be right in my directional assumption, which I'm really good at. And the stop loss range is much bigger because we get extra credit. So we have extra safety basically when we are neutral. Now, for the adjustments, again, they are mostly useful. They are a useful tool, but only if you plan to hold the position until expiration, or if you have an assumption the price will move in a certain way. I avoid making these assumptions because I find them not as profitable based on how I trade. My only assumption is the price will stay within a certain range for the next 20 to 30 days. This is the only assumption I take. So I never take a directional assumption. I'm just really bad at it. I found it not to work for me, at least not consistently. And this is trading neutrally is the only thing that's been working for me consistently for many years at this point, and with money management and so on and so forth. So let's go ahead and take a look. So we'll go over all the commodities, and I'll give you my thoughts on which one is a good candidate, which one is not. So basically I'm looking for the price to kind of be in a range. Now, as you can see here with gold, it's kind of like uptrending, so there's really no way for me to place a position or put it in any kind of reasonable range, because it's been uptrending for quite a while, since the beginning of the year, 2025. So let's look at silver. Silver, ideally, if we can get this kind of range for our stop loss, to our stop losses, basically, if we open the position and it stays within this range, we can make money. this will be ideal. The only problem is the price is really high, not really high, but it's closer to the top, to a point where even if I use a skewed triangle, it's not going to be very good because it's just way too close. So if the price would have been maybe in the middle here, so maybe at this point over here, I would have been happier to maybe open the position. So for now, not ideal, but let's think about it. Let's see if there's anything else, but not ideal. And if it's not ideal, there's no point opening up the position. Copper is also one of those not ideal positions, and this is and I'm just kind of putting what in my opinion will be the best range for a trade. So this will be a pretty good range. The price would have been moving within this range since March 2024, so a bit over a year. But again, price is a bit closer to the top. This one is a bit better than silver, but at the same time not ideal. Maybe if we just move it a little bit, still a pretty good range, but still not ideal currently. Let's go to crude oil. So crude oil is kind of the same thing. The ideal range will probably be somewhere maybe like that, maybe like this. Also not ideal, and you can definitely do a few tricks. Maybe lower it a little bit, and you have a much better range. But again, you can see most of the range was over there. Now another reason I'm not gonna even if everything would have been fine, I would have not traded, is because of the fundamental analysis. Just because of what's going on in the economy, and because the prices are pretty volatile for most commodities, not all of them. And I definitely don't want to play in a playground where volatility can just increase on me quite sharply and quite easily, right? But I'm not going to go into fundamental analysis in this video. I have a separate video for that. But this is why these positions are something that I would not open. So we have silver, which is definitely too close. We have copper, which is somewhat okay, somewhat yes, somewhat not. Again, if it's then there's no point. We have crude oil, which does look much better. But again, at the same time, my ideal range will be this, right? And it's a bit too close to the bottom. I can definitely get away with a skewed triangle, but let's see what else is out there. And we're looking for something ideal. If we can find something, this is exactly what we are going to go for. Now, let's see here. If we can get this range over here. It would have been a pretty good range. But again, the price has been somewhat directional, up, now down, and we are pretty close to the bottom range. So there's no point in trying to make it work. Let's look at ZW. So ZW would be the same thing. The range will not be ideal. It's way too close to the bottom, and then quite far from the top. And corn, actually corn looks much better. Let's see, corn, ideally you want to go for this range. And again, this is exactly what I do. Probably not every day. You're just gonna do it once, and you're just gonna follow the price and see what's going on. Yeah, this is not too bad. This might be actually a really good position. So we'll keep corn in mind. Let's see here. This is also might be a pretty good position. It's just soybean. So ideally, this is the range that I do want to get. You can see how this is pretty much dead center from to kind of have this range. This is even more ideal than corn. And then we have soybean meal, which is obviously not ideal in any way. Doesn't matter how you look at it. And we have soybean oil, which is kind of the same, not really ideal in any way, the price. So we have corn and soybean, which are my potential candidates, right? And again, this is all just mechanically looking at the graph. This has nothing to do with fundamental analysis. The reason I would not trade any of these right now is because we are getting into the harvesting and planting season, which according to seasonality, and every year commodities or the grains usually get pretty volatile during this time. So I'm not trading them regardless, even if I see a good opportunity. So my next step will be to go look at the commodity volatility index, which is the CVOL. So let's look at the CVOL for corn. So see, let's look at the 3 months. So it's closer to like the bottom half. You know, this, if this is the high, this is the low. It's closer to the bottom half. Volatility is not that high. Let's look at soybeans over here. See what it looks like. So soybeans, let's see. So soybeans are kind of the same. It's kind of closer to the bottom, right? So this is pretty much a giveaway for me to not open the position. But let's continue on. Let's say the volatility was, you know, anywhere in the upper 60% or so. Anywhere in the upper 60%, it's perfect for me. And I usually look at the 3 months. So, you know, anywhere over here, anywhere over this line would have been perfectly fine for me. I would have been okay with that. You can never expect a perfect volatility, but yeah, you can definitely expect for a good volatility, which is all we're shooting for. So if it's, you know, really perfect and all the way to the top here, you know, that's great. Then we take the trade. If it's like this, I'm not gonna take the trade. Now let me just show you a graph that is somewhat ideal. Even though on the actual range for soybean oil, it's not ideal. So you can see here volatility is relatively up or relatively high compared to the previous 3 months. So this is a perfect volatility for me, and I will definitely go for a trade. But this is soybean oil, and soybean oil, we have a pretty bad range here. So we are definitely not going to trade this product. So let's say we go for soybean, just for the soybeans, right? Let's say volatility is good. Let's say volatility is the best with soybean, right? You can see the price have been moving sideways within this range quite nicely. And my key thing is I wanna at least close to 3 months of price movement within my range. So in this case, price have been moving within this range since July of 2024. Right now and we're almost in May 2025, so, you know, 10-11 months, that's perfectly fine. Way more than 3 months, which is perfect for us. Now let's see what kind of range can we get if we take a look at the option chain here, and we'll open the position. We'll do everything. So let's see if we can actually get this kind of range when we look at soybean. And this is soybean September. So if you look at soybeans, so we have a few expirations here. So let's see here. This is July. This is August. Okay. So let's move it here. So we have 58 days, 93 days, and then we have 120 some days. Now, what I would do, I would definitely start with 58 days, and 58 days is a different contract. It's the July contract. Now, I'm not going to do it in this video because I know with 58 days, we will not have enough credit to be able to create this kind of range. The range will be much smaller. So, and again, it depends on the year. Some years the price doesn't move up and down that much. You can get away with 58 days. Here, for a fact, I know that we are probably going to need the 120 days. Now, also a little trick: if you have two of those contracts for grains, you always go for the first one. This is usually the more liquid one. So let's go and we sell the delta 20, in this case delta 21.6 call, and then we'll do the same thing on the other side. Will be delta 20.8. So this is a strangle. Let's go to the profile. So let's see. So if you go to maybe a 10% move, maybe 30% move, there we go. So let's say we have a $100,000 account and we are looking to risk no more than 4%. So for now, let's analyze it as one contract. So let's say we're getting about $1,500 in credit. It means our stop loss will be at $750, which is 50% of credit. So let's see if we can get closer. So basically, I'm going to go in and I'm going to look at the dotted line. I'm going to look here where it says minus 750, which is right here. And then I want to see where is it on the bottom graph here, which is the price of soybeans. So let's go to the left side. We go to minus 750 and we can see it says 9.45. So 9.45 means 945 right here. So this will be our bottom stop loss range, which is really, really nice. And now we'll go ahead and do the same thing on the other side. So 750, it will be 1103. So 1103, which will be right here. So you'll be cutting it really, really close. 1103. We'll be cutting it really, really close, which I'm totally okay with. So this is a perfect range. This is exactly what we were looking for. And again, you don't really have to go to 124 days all the time. It depends on what the market is giving you, right? Sometimes the range is way more narrow. So for example, here with natural gas, you can see the range is way more narrow. And here, I know because I traded it, like 45 days to expiration will do the job beautifully, very simply. But now, prices are just way more volatile. So you just need to get more premium to get a better range. And again, these are not the strikes, right? This is just the distance to the stop loss. Now, the range is getting bigger as the position is getting more profitable, obviously, even though we move the stop losses. Usually, as you move the stop losses or lower them on the position because it's profiting, your range to the stop loss will stay approximately the same. It's, all my values are not just kind of guesses. It's something that I've actually checked over the years. And basically, if the position is up 20%, stop loss will be minus 30%. On the graph, if you look at the position profile at that point, you will see that the stop loss is actually around the same point, just because the position is up 20% and stop loss is down 30%. So it always maintains a really good range, which is really, really important for us. All right, so this is a perfect range. This is a position that I would normally go for. The two factors that might put me away from going, or that turn me down from going into this position, is definitely the volatility, but at the same time is because I know that this is the seasonality. Usually starting April or May, usually I just stop trading the grains in April. The planting and harvesting season is coming to effect, and this is when volatility really picks up every single year. Sometimes more, sometimes less. Regardless, this is not this is not an environment that is good for strangles. But then after the season is over in usually July, this is time to get back and we can get some really nice positions. But again, this is to go over the mechanics. So all good, we like it. Now, let's say I want to risk $3,000, so 3% of my total account value, and my account is $100,000. So it means that my stop loss will be 3,000. It means that I need to collect about 6,000 in credit, which will be about 4 contracts, right? So 4 contracts will give me about $6,000 in credit, give or take. Stop loss will be about 3,000, and which is 3% of my account. And again, this is initially. As we move the position and the position is getting better and better, then obviously our risk will go down and down. So we will be risking less and less on the account while still having the same kind of profit target. So yeah, let's go. We have 4 positions. Now this is a demo account, so I'm just gonna go to market. It doesn't matter too much. I just want to show you how we are going to set up the take profit stop loss. Here we go. We got to fill at 29.5. We opened up this position. It's down 2.1% on a demo account on a market order, which is really good. It means we have really good liquidity. Soybean. So after the position is opened and we know the full price is 29.5 right here, let's go ahead and create the closing orders, the stop loss. So let's go close, and this will be the take profit order. So let's change from data to GTC. Now 29.5 is our fill price. It means that our take profit should be half of this, which is, if I believe correctly, 14.75. So let's go and look for 14.75 or for 14.75, just right here. So this is our take profit order because the position will be worth less than it is now, right? this is also pretty important to remember. So now we go to advanced, one cancel another. We'll choose the contract, which is the soybean. From limit, we'll change it to stop. And if you don't have the stop, you just press this button over here and you choose stop. Now, some people do stop limit. I just use stop. Usually I close my losses manually. I never actually close them, physically, just because I want to be able in control to get the best possible fill. Now, quantity will be 4, is the position from day to GTC. And here we're willing to lose 50%. So basically we will add 14 3/4 to 29.5, which should be 14 3/4. It should be 44 1/4. So let's go to 44 1/4. And it's always with interactive, it's always best to scroll physically and get to where you need to get. Just because if you mess up the minus sign, it will be a completely different order. But this is how you do it. You don't mess up with the buy and sell here. You just press right click and close, because you just want the platform to do the rest for you. So this is how I set up the stop loss. Click submit, transmit. Now we have the take profit, which will be always in green. And then we have the stop loss, which is being held and monitored. And whenever you need to move the stop loss, you just go here, you move it to the new value, whatever it might be, click update, and that's it. You move your stop loss. So I'll leave it at what we need, which is 44 1/4. And this is it. This is my strategy pretty much. But again, this is the mechanical side of the strategy. I want to emphasize the fundamental side of the strategy is extremely important, because you can get yourself in a lot of trouble if you don't know basic seasonality patterns. I do have a very, very detailed video about it for every single product, and you should definitely check it out. So this is it. Hopefully this video was really useful, very insightful. This is basically everything I do. Somewhat simple, but at the same time, very profitable. Again, thank you so much for watching, and I will catch you in the next one.